Hello, everyone. Jeff Fratarcangeli here. Welcome to another call to action. Those of you that are joining us for the first time, my firm, Fratarcangeli Wealth Management, has been in place for 30 years as of this year. That I started in the business when I worked in the World Trade Center and started building a practice that works with families, businesses, and everywhere in between, helping guide counsel through the ever-changing environment relative to their investments, but not just investments. We handle everything 360 degrees around their goals, their objectives, both on the personal side and business side. And that entails legacy planning, tax planning, benefits, anything that can impede the bottom line and the ultimate objectives that they have, near term as well as long term. The firm is now comprised of over 30 professionals with over 250 years of experience, with offices in 4 states, Michigan, Florida, Indiana, and Manhattan, New York, with the intent and the objective is of surrounding our clients with all the resources necessary to make the proper decisions to allow themselves to meet their goals in any environment and ultimately the end environment that they want to leave behind. That being said, we're very honored to announce that we were recently awarded the top #1 wealth advisory group in Michigan, as well as in Florida, simultaneously being ranked number 22 in the nation. And that has grown from 24 last year by Forbes, as well as rankings by Barron's with similar accolades, as high as 10th in the country and #1 in the states that we represent. And so we're very honored, and I'm proud of my team that has helped us navigate the situation, both financial planners, analysts, retirement specialists, as well as benefit specialists, to make sure our clients have all the resources. In addition to our immediate team, we have leveraged the soundest, most respected minds on the front lines, analysts, folks that are on multiple publications, and none better than our ace. This is our ace. Someone who does not need any introduction, but I'm going to give it a try anyway. Many of you know Mr. Wonderful, Kevin O'Leary, from Shark Tank, on the CNBC nighttime show that we've grown to love over the years, that I believe strongly Kevin is the anchor to that show. And starting out early in his career, having sold his company that he founded for $4.2 billion to Mattel, and then many acquisitions and sales since. You've been a part of investing in 30+ companies. Your success is well spoken for, well understood, and I'm so honored to have you, and my audience is as well. And you've been on the news just about every day. I mentioned to you I missed you because I haven't been in the same room with you, but I see you on TV just about every day. You're sought after for your opinion. And recently, you've been a part of the acquisition of TikTok. We all hear about the DeepSeek Chinese new company coming out and the data that they've leveraged here from our country. And we have so many other factors: inflation, a new administration, and the crossroads we face in this next turn of economic activity and what we should be doing. But starting with the topic that I mentioned, TikTok and DeepSeek, what says you, Kevin? How do we interpret the situation? What do we do with this next step, with this explosive technology expansion that we're in the midst of?
Well, there's no question that we have been in an economic competition, some people call it a war, for the last decade with China as they seek to become the world's largest economy and take that tag away from the U.S. market. We're nowhere near that yet, but it is a competition. And the tools of creativity and productivity are now focused on AI, and artificial intelligence was developed here in the U.S. It's a tool that affects all 11 sectors of the economy. One of the reasons the market remains buoyant is these tools have proven to be very effective, even in their nascent first and second inning, for pretty well everything, for whether it's insurance to financial services or design or software coding or whatever it is. AI is a part of it now, and we're very early on. So it's also not a secret that there are no IP laws in China. So much of their technology has been gleaned from, well, for lack of a better word, stealing it from ours, and that's got to end. And I think this administration is starting to focus on that. The Chinese have come into the WTO in 1999, and they have never played by the rules, and so it's very hard to litigate. You could just ask yourself, would the Chinese ever allow us to drop an AI tool called DeepSeek into their economy, to their people, let them download it on their phones and then scrape their emails and bring it back to the US. Not a chance in hell that would happen. So why are we letting that happen here? And I think that's what Congress is focusing on with this last order that looked at TikTok for doing the same thing. And so I think we're in the beginning of a real competition. We're going to be using tariffs, obviously, as well as making transfer of technology in some cases like chips from NVIDIA. That'll become illegal. And in fact, it is. And yet it's speculated this morning that 5,000 NVIDIA boards were used to create this DeepSeek, and it was at a cost of about 1.6 billion. So clearly it was sponsored by the CCP. This rumor that it only cost 6 million was done intentionally to roil the markets, and that it did. We lost $1 trillion worth of market cap with that rumor. So the Chinese are messing with us.
Do you have an opinion of how this can play out relative to an investor's approach? Is there reason to make changes to a portfolio that's balanced, that has technology exposure, and of course the chip sector? Do you have any difference of approach based on this most recent news?
No, I think all this proves is the value of AI. This is very akin to the early 90s when the internet came. People were skeptics. However, it completely changed the economy. We're about to go through that again with AI. I don't see a single sector or business, including in my portfolio, that isn't using this tool. And so, you know, what we really have to focus on now, and I think Trump has talked about this, is we've got to really get down and create enough energy so that we have enough data centers to compete globally in developing language learning models and all the other elements of cloud to be competitive. This is a race, and we don't have enough energy stateside. You need a gigawatt now for a modern day data center. So the only states that have stranded gas are North Dakota, West Virginia, and a province in Canada called Alberta. Those are the three places where data centers are going to be built.
Well, those in our audience that don't have or haven't seen you on TV talking about this topic, I can tell you over a year ago we talked about this. You were in South Dakota before one of our events. You flew in from South Dakota when we were presenting to a group in Indiana because you were working on this exact area. And I got to tell you, I use the analogy Wayne Gretzky looked for where the puck was going. Well, you're a prime example of that in the world today. You're there before anyone else. Let me ask you this. From our perspective today, we look at AI being the revolutionary factor behind this next chapter, but we also know the energy allowance that's necessary to implement what's coming is not where it's supposed to be. How do we play that opportunity to our advantage from your vantage point?
Well, I've always said about Trump, and people have listened to him for 12 years now, that you got to separate the noise from the signal. And he said something very interesting recently, which was very controversial. That's classic Trump, but the signal is very interesting. He talked about, buying Canada, and that's a tough pill for Canadians to swallow. But really, what he was talking about is an economic union, a behemoth economy that is second to none, that China would never catch up to. And so that's of great interest to Canadians, and that would mean a much more cooperative relationship around resources and particularly energy. The U.S., 60% of the imports come from Alberta. That's 4.2 million barrels a day into the U.S. from Alberta, and provides gasoline and energy to many, many states. And so I think what's coming is going to be, and I think we have to look at this because we are competing with China. There's no question about it. We got to build this economy and make it as powerful as it could possibly be, and then fund defenses in the north, not the 49th parallel. I'm talking the Arctic North against Russia and China, and I think that's part of Trump's plan. And I think we're going to get cooperation with the Canadians because they have an election coming, and there's a red sweep going there too. And so the new leader there is going to be very in sync with the Trump mandate for a giant economy. So I'm pretty excited about the North American markets for the next 4 years.
So what you're saying is Canada and the United States combined in a format that aligns together, not necessarily as one country, but yet an alliance relative to the power needs to implement and execute upon this revolutionary technology would 1 + 1 = 10, and no one could compete with us if we align that way. And that's the underlying message that was controversially interpreted. And I think, once again, cutting to the core of what's happening is we are, without question, strength. So that makes sense. Now, I'll be behind the scenes with my team looking at how to navigate that opportunity. We're already looking at it, Kevin. On the same general topic, we have an economy under Trump's administration taking over. We have a number of factors that we're not certain as to which direction, how it unfolds, with all the cabinet members being hopefully put into place in a quick fashion. And then what's the next steps with whether it's a new bill, one big beautiful bill. How do you anticipate this next several months and then beyond that playing out for investors? And how would you suggest we consider navigating it if there's a uniqueness to how we would go about that?
Well, Trump knows he's got a majority mandate for 24 months. Usually in midterms, you lose some seats. That's just typical for any administration. So he wants to get this stuff done fast. And he's done 43, executive orders already, and they're coming hard and fast. And he knows, he's now building his legacy. Trump 2.0 is about, doing what he said, and he made a lot of promises he's got to deliver on. The most important for all of us on this call is the tax package, which is in reconciliation right now in terms of it being designed. And that's got to get put through by the end of the year. So that, in government time, that's not a long period. But to make those tax cuts permanent, it's very important for investors and for earnings in the S&P 500. So, and I'm not talking about 15%. I'm just saying keeping the 21% that exists right now is very important. So that's mandate number one. And there's the Freedom Caucus, Eli Crane and that team. They're very concerned about reducing debt, and they should be. And so you're going to have to get some compromise on cut spending somewhere. And I think Trump's on board for that with this whole Doge thing. Secondly, he's deregulating everything federally. He's erased almost everything in the first week that Biden put in place, and he's not finished. So that's also good for business federally, no question. And I think that's why there's a fair amount of optimism, why you're seeing, for lack of a better word, a lot of sucking up to Trump for the same adversaries, the tech leaders, et cetera, that really didn't like him in the first mandate are going to Washington and Mar-a-Lago every week. So they see the writing on the wall, they can read the room, and they understand the American people are behind this guy, and they want stuff done. And so it's good. It's really good. And we're going to get this immigration thing worked out. You're seeing this happen every day. There's a lot of good stuff happening. It's happening very quickly, and people aren't used to that. But I think staying the course in the American economy is the place to be. Fed's probably not going to reduce rates anytime soon because inflation is still way north of 2%, and that's their mandate. So, and they don't know what the effect of tariffs are going to be, or which countries get the tariffs, or all the rest of that stuff is an uncertainty. But tariffs is just a negotiating tool for Trump. We saw him do it with the Colombian guy that he's trying to send back the criminals. He came to pretty damn fast. So the same thing's going to happen with other countries. I can't. You think about allocating. Where would you go? I mean, I think the action's in the U.S. right now.
And it's been that way since 17, quite frankly, if you look at the equity markets comparably. You hit on one of my next questions, but I'm going to push it a little further. Tariffs and inflation. You mentioned, and I quote, tariffs are a way of having actions taken by others changed and altered. You're altering their thinking. How do you correlate tariffs and inflation, if at all?
Well, I mean, we've got a good case study right now, the threatened tariffs on Canada. Well, the problem with that is 17 states, their number one trading partner is Canada. The number one import from Canada is oil at a discount coming out of Alberta. So, I think the threat of tariffs there is just to get this fentanyl border thing worked out. And you've already heard from some of the premiers in Canada that they're willing to put money to work to stop fentanyl moving. They don't want it either. Nobody wants fentanyl criminals. So Trump's already getting action. Now, if it was true that they were going to slam on 25% on top of energy that's coming out of the East Coast refined out of Irving, out in Nova Scotia, and then 25% on $200 billion of the oil coming out of Alberta, that's not good. That would be very that would counter inflation just on energy input costs. So I don't see that actually happening. My guess on this one, and the way I'm playing it, because I haven't invested in Canada in 8 years, but now that they're getting rid of the guy running the place and putting in a conservative guy, I've started to nibble because the Canadian dollar has dropped 41%. It's 41% off retail. So I'm buying equities in the Canadian market. They got good banking, they got good energy, they got a bunch of sectors, and those are the cheapest I've ever seen. So I'm trying to get ahead of the trade here by adding a little bit of Canada to my portfolio, because I anticipate in the weeks ahead, the conservatives are getting a majority mandate, just like Trump got. And then there's going to be this super negotiation we referenced earlier around NAFTA 3, where maybe we can get to a common currency, because Canadians would rather trade in US dollars anyways. That's how they mark to market all their commodities anyways. It's all American dollars. And maybe an EU passport system like Europe has. And then, of course, completely eradicating all tariffs so we get the super economy to compete with the Chinese with. So there's, I think, a lot of upside there. But you want to talk about something on sale, it's Canada. The Trudeau peso is practically worthless. So it's one of the reasons I'm investing in data centers in Alberta, because they're 40% cheaper than the same things I'd build stateside. But we'll see. It's kind of like you always want to go to where the puck is going. You're right. That's the great Gretzky thing. But I just see a lot of opportunity right now. Just a lot of in chaos, there's opportunity. That's what I like.
When there's blood in the streets, that's usually where you want to go. Now, my audience may not know this, but I think many do. You're a Canadian. You were born and raised in Canada initially, correct?
Yeah, I was born there in Montreal, and then I've raised my family in Boston. So we're kind of American/Canadians. I figure I've got a foot in both markets. It's a good place to be.
Yeah. There's the history we don't have time to go through, but I was even reading up more on your history. I mean, you've been so many places, and what drives me to really watch you is that I know you're so successful. It's obvious, but yet you don't stop. You just keep coming and looking for. Is it a game for you? What keeps you motivated,
No,
Kevin?
I've just I'm sort of the ambassador of the American dream. If you think what happened to me on Shark Tank, 17 years, #1 show in 54 countries. I can go anywhere in the world, and I always tell people our #1 export out of the U.S. is not energy or technology. It's the American dream. That's the #1 export. And so I just feel like I'm an ambassador for that. And I go around the world anywhere I want, and they know. I mean, the thing about entrepreneurship, it's bipartisan. It doesn't matter when you go left or you go right or blue. I can talk to any senator, governor, even Elizabeth Warren and AOC. They want to create jobs. So I'm that guy, and I'm very proud of it. So that really motivates me to get up in the morning, support my companies, support what we do. I'm going to Tokyo on Sunday. I mean, I'm all over the place, but it's just it keeps me young.
Well, you look younger when we watch Shark Tank today or have you on the screen. When I look back over the reruns, I'm like, well, Kevin got old. And then I realized it was 15 years ago. You look better today. So whatever you're doing, it doesn't slow you down and doesn't make you look like you've been going too hard. So I'm going to have to pick your brain on that one. Listen, you're optimistic. You feel like this type of environment creates opportunity like no other, which we've learned in my 30 years is when people are most fearful and the VIX or the fear index spikes is usually when the most opportunities are there. The fact that the market has to go down to go higher is something we've learned the hard way. If you had to peg one thing or maybe a couple things that has you most concerned relative to something out of left field that we don't anticipate coming to the fruition, or just something that this needs to happen in order for this to continue, what would that be?
Well, the way to answer that question is what you learn to experience in investing. There's always people that think they can time the market, that kind of say to themselves, well, I see a lot of volatility. I'm concerned about China. I'm concerned about the war in Europe. And I'm going to go to cash for a while I figure this out. That's always a mistake, because in modern times, over the last 20 years, we have market conditions where the majority of the gain in your portfolio happens over a few days. You get these incredible days where you either go up or down, 2,000, 3,000, 4,000 points. And it's impossible to know when they're going to show up or for what reasons. I would think about the NVIDIA story with the Chinese DeepSeek that took unprecedented, it's never happened before, 680 billion market cap off one stock, NVIDIA. And of course, it started to recover because everybody knows that's a BS story coming out of China. But you, and so the gains will on that in technology, you got back 15% in 30 hours of trading. So you can't time the market is my message, and nobody should try. You need a diversification in the portfolio. No, in my view, it's no more than 5% in any one stock, no more than 20% in any one sector. And then you ride the pony. And the only thing that you have to do is decide how much do I want in fixed income, because maybe I'm taking care of a charity or my family, whatever it is, and how much am I leaving for the long term in equities. And I've never varied from that, in the most volatile times. And I've seen others try and time the market, and they get smoked. They just get slaughtered. And the market is cruel to market timers, just cruel. And it just somehow has a way of really punishing you for trying to do that. So I don't do it.
Well, I think what I'm hearing you say is your biggest fear of missing out, FOMO, as we call it, right? You're fearful of not catching that opportunity. And I think I've heard you say before, the recoveries are violent and they take very short periods of time to capture the sell-offs or the opportunities that the fear created. And that's, am I missing anything? Am I leaving anything on the table is what I'm hearing you say, which tells me we think alike. That being said, your family, I know from our history of conversations, you may have mentioned it other times. What are you doing with your family wealth? What is your, I think you've talked about it a little bit, maybe you can expand upon it. At times you were 50-50 in equities and fixed income, and other times you were 70-30. How you're investing, we invest in your exchange traded funds continuously, myself, as well as our portfolios. What is Kevin doing differently, or what is he aligning to that he's done in the past that he believes even stronger?
Yeah, I have a very simple philosophy on this. Obviously I'm partnered with Alps because they bought my indexing business, or at least the O shares, and they've grown them considerably. It's sort of, people know me for Shark Tank and all the risky investments I make there, but that's not where the real money is. That's not where I keep my family wealth. I use indexes. I'm very specific about them. OUSA, which is a subset of the S&P 500, very, very conservative. As I like to say, these are really boring, these ideas, and I like boring. I like boring, stable, profitable companies that are growing their dividends without using debt, and that's exactly what you're going to find in OUSA. It's a I don't want to own every S&P 500 company because some of them just don't fit the quality metrics I care about. We're talking about long money here. This is where I don't trade it. It just grows, and it provides for a lot of things that my wife and I support. And it's a very tax efficient way of owning equity. So that's, in the case of my U.S. holdings, that's 40%. That's the big one. So. I think that one, Jeff, and I think some of the people on this call probably own it, and I think it served you well. And it's great in volatile times, but it's all quality. Consistent. And then I also like to have a little bit of slightly higher growth, which you're going to find in the Russell 2000. But unfortunately, the Russell 2000 is full of companies that don't make any money. And those are just speculations. I'm not saying you can't speculate, but for long term, I want real companies growing slightly faster than the S&P 500 that are paying out dividends. So, OUSM, it does that quality sweep across all 2000 and finds just the right ones that deserve to be in a more conservative portfolio, and that's 20% as well. And I own a little bit of Europe in OEUR and a little bit of OGIG, which is highly speculative, but technology of the largest market caps, and it served me well as also. And so these are all indices, but the big daddy is OUSA, and in combination with OUSM, that's all US, and that's 60% right there.
Yeah.
And then I just clip coupons because I get paid out every month. And they provide the distributions that my family needs and the charities that we support. And I don't, I let the system work. It just does its thing. And it's, you know, sure, once in a while I'll buy a stock, but the big money is in these indices and has been for a really long time. And as I like to tell people, they ask me, what are these? I say, they're really boring, very, very boring. And boring is good, really
Right.
good.
So those of you that the high quality blue chip companies that pay dividends is what he's referencing for the 40%. We capture it in multitude of approaches, but it's not buying a straight index. It's selectively choosing from companies in a couple variations. And in that particular ETF, I personally invest in. So it's a part of that. And then, of course, there's the growth component. But once again, we don't want to buy all of the companies because if they're not making money, they don't fit our criteria. And I agree. So you're buying select companies on the growth side to give you both balance. You do dip your feet in international opportunities, but it's really a focus of domestic. And then finally, it's the fixed income for your charities and income needs that you have. And if I could be so bold, Kevin, what's your mix? Every time I get with you, I always like to find out if you've shifted any further to equities or back towards any emphasis in bonds, if you will. So you have equities, bonds. What's your percentage in each today? And are you changing that anytime soon?
Well, we were looking at that, Jeff, in November and December and decided to stay 70 equities, 30 fixed income. It didn't make a change. It's been that way for years. Based on just my bullishness of the U.S. economy, I'm pretty close to it. I've got 50 private companies, so I get to see their data every week. And a lot of them are Shark Tank, but many are not, and sort of, and there are generally those companies make about 15% traditionally. This last quarter, they made 17.5% free cash flow pre-tax, which is the best quarter we ever had. So it's sort of like an index that the consumers are still quite strong. There's always stuff to worry about, but I think I'm going to stay 70-30 for another couple of years. If you have any kind of nervousness, you can go to cash and make right now, in 90 days, 4.2, 4.3%. So you don't have to go long duration fixed income right here. You're getting paid to wait, but I still think equities are going to outperform that as well. And so, I mean, it's remarkable. We're positive in a very volatile. Usually when you change administrations, you're all over the map. But here we are. Fed stays steady. I think Trump has a good chance of driving through these permanent tax platforms, and I think that's fantastic for the economy. It really goes to where else would you go? I mean, it's sort of, yeah, I have a little bit of Europe. I got a little bit of Asian tech and stuff, but for the big dough, I don't think I'm leaving domestic markets. I don't find anything that attractive anywhere else.
Yeah, I agree. Excellent. Well, I'm going to summarize here shortly, but Kevin, no question. What would you want if these people that are joining us today are folks that have given us our ability and given us the ability to help protect and guide them? Many of people will be watching this not only today, but we're going to be sending it out. A message you want to leave us with before I tie it together, if you don't mind. No question attached. Just what haven't we talked about that you would love to make sure we hear?
Well, I go back to the overriding message. Don't try and time the market. Nobody can. And the key that I know you provide, and which is why you're successful. By the way, congratulations on that award. That's very tough to get. I know that. I know this industry pretty well. That's not an easy
Thank you.
ticket. So you're doing something right there, Jeff.
It's because of people like you that help us.
Well, no, I
Please.
think it's really great. It really is. The key, your number one role, actually, this is my own perception about why you're good. You shouldn't focus on performance. You should focus on preservation of your wealth. Stretching for performance is never a good idea. You want to meet the market's indices. You want to get the same the market's providing with less risk. That's the whole idea. Once you've made money, the last thing you want to do is give it back. Like that's I'm all about preservation. You know, I don't care if I beat the market by 200 basis points or I miss it by 100 basis points. I don't care. What I want to see every month, I look at that nut and I say, oh, there's my nut. And I love my nut and I want to keep it.
Income, cash flow.
Yeah, I like that. I love the cash flow, and I just like to see the whole port. See, listen. I'm mark to market every day. Every day at 4:05, I look across my, I'm not going to call it an empire, but all of these companies and all of my positions and everything. I have a big dashboard I've developed, a tool that I see on my phone. Maria, my head of finance, keeps it current, and I'll tell you something very interesting, just to give you an idea of why I like to do that. Yesterday, I was down here. I'm at the Whitby Hotel in New York, and 4:05, I'm downstairs getting a snack because I was going to do some Fox TV later. And I'm whipping through the dashboard, and I see two payments to credit cards, one for 87,000, one for 82,000, to the same credit card. I'm thinking to myself, what's that? So I call up Maria, and I say, what's going on there? She said, that's got to be an error. I said, damn right it's an error. Why don't you call a bank and see what's going on? I'm an eagle hawk looking over my money. And that's what everybody should do, to take the time to make sure that you're preserving your wealth. And that's your role as the matriarch or patriarch, is to make sure that you're leaving something behind and you are a great steward of it. And obviously, Jeff, you provide that ability. Your job is to force diversification, force it on people, force it on them when you get a huge win like a Tesla or an NVIDIA or something. Force diversification. You do that and you're serving your clients well. And above all, you've had great performance. I've known you years now, but above all, I think you're fantastic at preserving wealth. Preserving wealth. That's my message. The
Beautiful.
older I get, the more I want the preservation and the risk management. So it took me a long time to build this up. I don't want it going anywhere.
Yeah, beautiful. I do the same thing. It pops up on my phone when I see some outstanding, and I'm like, what is this? I call my bookkeeper, and but my numbers are substantially different. I'm talking about $500 that I'm like, well, how did that happen? But I understand your point. Listen, consistency, that's what you bring, cutting to the core of the actual concerns that our brain gets clouded with, and then how to act. And it's interesting because you're consistent and how you approach cash flow, and consistent on diversity and preservation. And I've had the benefit of working with generational wealth, generational 3-4 times out, and then new wealth. And interestingly enough, the new wealth thinks they've got to dig in and hit the grand slam every swing. Your newer wealth, if not the new wealth, I think, if I remember, but yet you've learned. And then there's the generational wealth that knows preservation, consistency. What's our job? Make sure that we have enough liquidity to overcome the unforeseen. Have more liquidity than maybe you think you need, because it's coming. It's not a matter of if, that we'll have that contraction. And then outpace inflation. Make sure your money is combating the cost of living for the next generation or for years to come from now purchases that we'll be making. And you've been able to articulate it better than anyone I've ever met. And I was so excited about bringing you on because I knew you would. You've consistently led, and I appreciate you. My call to action is as such. In any environment, regardless of whether you're blue, red, in the middle, or everywhere else. And I'll put up a chart that'll support this. If you look back to historical administrations, going back to Jimmy Carter, who, bless his soul, left us recently, all the way through the most recent president and presidents before, with the exception of 2 terms of leadership that were outlying scenarios like the dot-com bubble that we all endured as we were guiding clients that we'll prepare for if it comes again. We've seen a consistency 10 to 15% return with an average return of 14.9% as an average, 14.7% under Democratic leadership and 15% under Republican leadership. So it doesn't matter. It doesn't matter. What matters is not trying to time the market, diversifying the 5 and 20 that you said, 5% in any company, 20% in any sector, and continuing to do something that we refer to consistently, which is dollar cost average. As you refer at the nut. As the nut comes in, putting it back to work and balancing your portfolio out. Here we are today. I'll be sending this chart to all of you with a little bit of bullet points from this takeaway. I thank you, Kevin. I thank my audience. And I look forward to seeing you all again. We're here with all hands on deck, ready to help and guide and counsel our clients. And Kevin, I'll see you soon, my friend. I appreciate you. Bye
Thank
for
you,
now.
Jeff. Take care.